Buying your first home, refinancing, improving your credit score, buying an investment property, or even home design tips. We got you covered.
Welcome to Mortgage Matters, a show where we talk about home buying, refinancing, and mortgage tips with Shashank Shekhar, the CEO of Arcus Lending. Welcome, Shashank.
Thank you.
So, Shashank, we have talked about home buying, mortgage, and one of the most important thing in both of this is the credit score.
Of course.
So why is the credit score so important?
So we have talked mostly about mortgages on this show, but credit score is one thing which is relevant to pretty much everyone who's watching this particular segment. Whether you're thinking of buying a home or not, of course we understand that when it comes to mortgages, credit scores are extremely important. But even if you are several years out, maybe you're just trying to get an educational loan, you're just out of college, you are trying to apply for a job, as even with employment, employers these days pull credit reports. You're trying to get a car loan, they pull credit report. Even with insurance, I'm told that there are some insurance companies that pull credit reports. So credit scores are important not just for mortgages, but any kind of debt that you're trying to acquire, employment, insurance application. And that's why understanding how credit scores work, understanding that how you can improve your credit scores as the time passes by, is one of the most critical knowledge that pretty much everyone in this country should have. And I personally think that this is something that should probably be taught in high school or colleges, so that people are financially literate and they're able to figure out how credit scoring works, not after several years when they have made mistakes which will probably take a lifetime to fix.
But what usually impacts the credit score?
So credit scores are impacted by several factors. They are basically, primarily there are 5 different factors, and I'll talk about that. The biggest change in your credit score, or the biggest thing that impacts your credit score, is your payment history, and that's kind of commonsensical, right?
Yeah.
Because most of us would think that if we have a debt, we make our payments on time, then our credit score should be higher than somebody else who does not do
Exactly.
that. And that's about 35% of your credit score. So if you see 700 score, 740 score, understand that about 35% of that comes from clean, neat payment history. Or otherwise, if you're not making your payments on time, then of course you will have a low credit score. The second factor that impacts the credit score the most, just after the clean payment history, is your utilization of credit. Meaning, how much of credit do you have and how much of that you're utilizing? Let's take an example of a credit card. Say you have a Citi Visa card, and you have $5,000 limit on that thing. How much you're utilizing on that on an every month basis? The more that you are utilizing that, meaning the more you are spending on your credit card, people who are utilizing say $4,000, $4,500, or $5,000 out of a $5,000 limit will have a lower credit score versus people who are only using say $500 or $1,000 on that credit card. So credit bureaus like the fact that even if you have higher credit limits, that you're not always maxed out. They want to see that you have other sources of income from where you are making most of your spending. So overutilization of credit score or underutilization is the second biggest factor. The third thing that they look for is the mix of credit. What that means is that what kind of credit that you have. Do you only have credit cards in your portfolio, meaning all you have is like 5 credit cards, a Macy's card, a Nordstrom card, and a Citi card, and a Bank of America card? Credit bureaus don't like that.
Yeah.
Credit bureaus like the fact if you have a mix of different credit cards. If you have a mix of different debts, meaning you should have credit card, you should have an installment account like a car loan, and you should have preferably a mortgage. Not everybody can have mortgage, especially if they're young or if they're new to the country. But credit bureaus like the fact that you can manage different kinds of debt. You can manage a credit card, you can manage a car loan, you can manage a mortgage debt. The fourth factor, which impacts the credit score, is how long you have had the credit history for.
Yeah.
So we talked about in one of the earlier shows that people who are new to the country or just out of college, they may not have a very long credit history because they just established their credit history. Those people might have lower credit scores than people who have had 5, 10, 15, 20 years of credit history. So the length of credit is something that impacts your credit score. And finally, something which has a very small, minor impact on your credit score, those are called inquiries on your credit score, meaning the more that you're applying for debt, the more different banks and lenders will pull your credit. And credit bureaus will see that. They will see that you're applying for a lot of credit or a lot of debt from different places. And again, bureaus don't like that. If you're always shopping for a new credit card, always shopping for a new car loan, even mortgages in some cases, credit bureaus don't like that. So those 5 factors combined together makes 100% of your credit score.
So how long of a credit history you need to have?
So there is really no rule of thumb to it. And people who have had even, say, a shorter credit history, meaning 3-4 years credit history or something, but they have made all their payments on time, they're underutilized on their credit score, they have a good mix of credit, they could have higher credit score than people who have had it for 10 years, but they have missed a couple of payments. But when it comes to mortgages, meaning if you're trying to qualify for a mortgage, then typically you need about 2 years of credit history in most cases. In some cases, some very special loan programs may even require 3 years of credit history, but there are exceptions even with less than 2 years of credit history. If you have excellent employment and income history and everything else looks good with your loan, in some cases, even with a 16, 18 months, maybe even some 14 months credit history, could help you qualify for the loan program you're looking for. So again, just because you're new to the country, you're just out of college, you have a very new job, and your credit history is not that long, don't just think that that's the only reason you will not qualify for a loan. Always check again with a loan consultant, with somebody who's an expert, and maybe they have some loan programs that can help you qualify with that kind of a credit history.
Well, on that note, viewers, we'll take a break. Do come back and keep watching Mortgage Matters. Welcome back, viewers. You're watching Mortgage Matters, and today we're talking on credit scores. Welcome back, Shashank.
Thanks.
So Shashank, we're talking about credit scores. Now I want to know from you, what does not impact credit score?
And that's extremely important, right? We talked about the fact that those were the 5 factors that impacts credit score. Because a lot of people think that there are so many other things that impacts credit scores, and I've heard it several times from my clients. They're talking about the fact that I have great income, and I make so much money, and wouldn't that have something to do with credit scores? No, the answer is income has no impact on credit scores. Somebody who's unemployed and somebody who makes $1 million a year may have exactly the same score. In fact, the person who's unemployed may have higher credit score because of all the factors that we talked about before. The other thing that people think that might impact credit score is assets. How much money do I have in the bank? Will that impact the kind of credit scores do I have? Or how many accounts I have? I have a checking account, savings account, all that stuff. Again, assets have no impact on your credit score. Of course, you can use those assets to make your payments on time, and that will help you improve your credit score. But the income alone or the assets alone will have no impact on the credit score. And finally, one more thing that I hear is, again, the immigration status. That I'm on H-1B, will my credit score be worse than somebody who is a citizen or has a green card? And answer again is no. So these are the factors that do not impact credit score. So always remember there are only 5 factors that impact the credit score. There is nothing called a 6th factor. So as long as you remember those are the 5 things and you action on that, you will have better credit scores than most people.
So what is a good credit score to get a mortgage?
So that's a tough question in the sense that credit scores ranges are huge. If you look at the bureaus, most bureaus range you between 300 and 350 on the lower side to about 850 on the higher side. So that is a very wide range. Most Americans would fall anywhere between 640, 660 credit score to about 740, 760. So that 100 points band is where most people fall into. And there is a loan program for all those credit score points that you can have. Of course, with mortgages, we say that the better your credit score, chances are you'll get a better interest rate. So we are talking about 2 different things. One is, do I qualify for a mortgage if I have a not so great credit score, say I have a 660, 680 credit score? Yes, you do. There are loan programs that will allow you to qualify even with less than satisfactory credit scores. But if the second question is, or I'm thinking if that was, say, maybe another intended question or a follow-up question, is that, okay, I qualify for the mortgage, but do I get the best rates which are available out there? Then you're right. Then the answer is no. Because with the same guy with a 660 score versus the other guy with, say, 740 credit score cannot possibly have the same risk for the lender. The guy with a 660 credit score is a higher risk if I'm giving a loan to that guy versus somebody who's at 740. So be prepared to pay a higher interest rate when you have lower credit score. But you know what you can do is that if you take that 640, 660 credit score, get a loan at a higher rate, put that mortgage on your credit report, pay your mortgage on time for 6 months or 12 months or some time, and then your scores will actually go up. And then you can come back and refinance and hopefully get a lower interest rate.
So like we had talked about in our previous segment about someone having $5,000 credit card and then they max it out. But what if that person pays that full amount, $5,000?
So every month?
Yeah.
So they keep spending it and then they
keep paying it out.
Okay.
And have zero credit, they have zero balance on it.
Nice. And that's what a lot of my clients do.
Yeah.
And they think it has no impact on their credit score. Surprisingly, and it will be a surprise to a lot of people watching it, is that it has a huge negative impact on your credit score. And I'll explain you why that happens. So when you get a credit card statement, what does the credit card statement show? It shows that you have spent $5,000 against a credit limit of $5,000.
Yeah.
That's what gets reported to the bureaus. The payment that you make to the credit card is not what the bureaus see at that time. So if I was a mortgage lender, I pull your credit report at that time. Credit bureaus see that you had a $5,000 limit and you spent $5,000. So you're maxing out on your credit card. Even if you paid it off or paid the entire balance at that point of time, that's not what credit bureaus see. So credit bureaus ding you for that on maximizing your credit, maximizing on a credit card. What you can do, which is a sneaky trick, is if you actually pay off your credit card every month, do it 2 or 3 days before you get the statement.
Oh, okay.
If you do that, then your statement will show a zero balance because you already paid that payment. Your statement will show that you have a $5,000 limit and you have a zero balance on that. And that's what bureaus see. And when the credit bureaus see that, they give you brownie points for that. Look, this guy has all the credit balance available, but he's really not utilizing it, meaning he doesn't need it. So it was a very, very important question in the sense that a lot of people think the same way, which is, I don't care how much money I spent on the credit card. As long as I pay that off every month, I should not be impacted on my credit scores, right? But it does impact you. It does impact you if the credit score is pulled at a time when your balance is high. And that's why anyone who is trying to get mortgages, I tell them few months before you get your mortgage, try not to overspend on any given card. Try to keep it under 10% or even 30% of the limit of that card. Try to spread your spend into several cards that you have. Don't overspend on one card, and that will help you get a much better credit score, of course help you qualify for a mortgage, and help you get a much better interest rate on that mortgage.
So what are some of the misconceptions of credit score?
So one was
like
that huge misconception, as in people have credit card and then they think that as in they can spend and they can pay it off and they'll be fine. Some of the others are they just don't know what impacts credit scores, and we talked about that. And one of the other things is that talking about going back to the same question of if I have a credit card that I spend often, what do I do with it? What they can do is that if they have to spend $5,000, maybe they're out on travel and they can't be using, say, their cash or something else, then spread that spend across, say, if you have 3 cards, use $1,500 each on all of them. Don't use that $5,000 on one of the cards. And so when you do that, then none of those credit cards get overspent and you will not be hit by the credit bureaus because of that. So understanding how credit scores work, I actually have an ebook on this, and they can download it on arcuslending.com. It's a free ebook that I wrote about how the credit scores work and how they can actually benefit by understanding what impacts credit scores and what does not.
Well, viewers, I hope your misconceptions of credit score have been cleared now. Do come back and keep watching Mortgage Matters after this break. Welcome back. You're watching Mortgage Matters, and today we're talking about credit score. Now we're going to take on some of the viewers' questions.
Sure.
First, we have a question by Sunil. He said, on Credit Karma, he sees a score of 768, but when his loan officer pulled the score, it was 722.
Oops.
Why is that?
That's an ouch moment, right?
Yeah.
All along you've been thinking that you have a 768 credit score. You're so excited about buying a home. You go to your loan officer, he pulls the credit report, and ouch, you have a 722. That's what he said, right?
Yep, 722.
It's not uncommon, though, something like that. The reason for that, Kritika, is that there are two different kinds of credit scoring. There's something called consumer reports, and there's something called mortgage reports. So what we as mortgage lenders pull uses a completely different algorithm and formula at the credit bureau's end versus what you would see if you were to pull your own report. So Credit Karma is one of the websites where consumers are able to pull their own credit report, or they can track their credit scores, and they can see what that score is. And it's just because of the fact that the formula or the algorithm that Credit Karma uses versus what we will use as a lender is different. And those scores, he has about 40 points score difference between what he sees there versus the mortgage score. Sometimes could be worse. I have seen credit scores where somebody on Credit Karma has had a 760 credit score, and when we pulled it was 682. So that's almost like 80 points difference. Yeah. And those differences are much bigger if you have had a late payment, or if you had a collection, or if you had something wrong on your credit. The reason for that is that the consumer report dings you a much smaller, say, portion of your credit score for if you made, say, a late payment. On the mortgage side, because the risk is so much high, because you're borrowing such a big loan amount, there the ding is much bigger. So the people who have had excellent credit score, meaning they have never had lates or collections or judgments or any of that stuff, on those clients, I see a much smaller difference. So on Credit Karma, if they see 780, if they come to us, we'll probably see 770, 775. It's usually in line with what they see, what we see. But people who have had that, say, one missed payment or something, they see a much bigger difference. So I don't know what's the case with Sunil, because of course we don't have access to his credit report right now, but it could be a reason that where he have had a missed payment sometime in the past, and so the mortgage credit score is hitting him much more than what a consumer credit score would.
Well, then Sunil can contact Shashank Shekhar at Arcus Lending, and he can get the answers for that.
Sure, of course, we can review his credit report.
So Shashank, the next question is by Anjali. She owns a business and she has a business card, and she says that she cannot spread her credit card charge on different credit cards because she has one business card.
Sure,
so in her case, what does she do?
I know we talked about the fact that people should ideally be spreading their card because that's how one credit card does not show a much higher utilization.
Exactly.
Now, one, of course, we talked about that in the context of if someone is actively looking to get a debt, like if they're actively looking to get a mortgage. Because if you're not, then you're not too much worried about your credit score fluctuating by, say, this week if it's up or the next week it's down. As long as you're making your payments on time, overall your credit scores should be excellent. Now, if I assume that she is indeed looking for a mortgage and she has this problem where she cannot spread her charges across different credit cards, then she should get back to probably another advice that I gave, which was maybe she should pay off her credit card a few days before the statement comes out. And if that's too much to ask, because again, with business owners, and I understand that, they want to take the credit for as long as they can, then maybe not pay off the entire thing, but pay off maybe 60, 70% of that debt before the statement comes out, so that the credit bureaus see low utilization. Yeah. And also, again, all of this she only has to do while she's actively looking to get a mortgage. Once that's done, she can go back to charging her credit card to the max and then paying off whenever she wants to. Really, as in all of this is management, right? Yeah. When you're actively looking for a mortgage or for any debt, you have to manage your credit card and your credit scores in a much more prudent fashion. Once you are done, I'm not saying start missing your payment and start charging your card with Nordstrom jackets, right? but at least during when you're looking for a mortgage, you should be a little bit more prudent, a little bit more planned and managed about your credit cards.
So now the last question we have is by Siddharth. He says that he's new to the country and has very little credit history. How can he improve his scores?
Yeah, that's a challenge which a lot of immigrants have. And of course, at Arcus Lending, we work with a lot of them who are probably newer to the country. And one of the challenges with credit that we see is they don't even know where to start in the first place. One of the best places to start is probably a bank where they open their checking account. A secured credit card is a great way to start your credit history. All that a secured credit card is that you pay a deposit to the bank, they give you a credit card, and you can only spend up to the deposit you gave them. but at least they report it to the credit bureaus. And in fact, that's one thing that everyone should check with their bank when they get secured credit card is that, will you be reporting it to the bureaus? Because if they are not, then it's useless for their credit history. Also, the other thing they should do is probably get to a credit union and get a car loan. Credit unions are usually more lenient on credit history. As long as your employment looks good, income looks good, they will most likely give you a car loan. If you're able to get that, get that car loan and keep it for as long as you can because you're trying to build a credit history. And if you have one or two, and then again, a couple of store cards are a little bit more lenient. You can get one or two store cards where they don't look for a very long credit history. Do few of those things, keep about a couple of credit cards, keep a car loan for about 12 months, 24 months. By then you will have enough credit history and enough good scores where you can maybe apply for better credit cards at that point of time. But also don't close some of the oldest credit cards. That's another mistake which a lot of new people do. The moment they get better credit cards, they close their old credit cards. The longer you have a credit card on your system, the better your chances of a better credit score because of those credit cards. So don't close them yet. Keep them for as long as possible. But really, those 2-3 tips usually does magic for most people who are newer to the country.
Well, viewers, I hope you enjoyed our tonight's episode of Mortgage Matters, and I hope you got to learn about credit score. If you have any questions relating to credit score or mortgage, you can email mortgagematters@arcuslending.com, or you can post your question on Arcus Lending's Facebook page. Till next time, it's me, Kritika Aswani, and Shashank Shekhar, signing off from Mortgage Matters.